Hey guys, I'm Sina from 21st Capital. Today we have another show with CryptoVizart from Glassnode. Today we are going to discuss the recent market action. We've had quite a bit of a sell-off in the market. We will try to understand what happened and various. Okay, I had two tabs open. Right, so we will try to look at futures market, on-chain analytics, and macro. All the things that, all the major parts of the market that might impact the trajectory of Bitcoin moving forward. And we'll try to understand how far we might go and essentially where we are in this correction. Welcome, CryptoVizart. How are you doing?
Not bad, not bad. What a day. A big crash. Let's look into what's happening.
Yeah. So let's take a quick look at the numbers. Well, we went up all the way up to above 108, and then from there, correction back down to 92,000. Oh, we actually did come really close to 2,000, 92,000.
Wow.
And then back up. Right now, we are at 96.7. It tried to recover, failed. Now it's probably going back down and see, where we can, where this will find some support. So just very quickly, our long-term indicators like VPLI would still put us at a neutral place. We are far from the typical tops of the market. Here, for example, a trend line, a power law trend line would put us at 84,000. We are at 96K. Not too far, at least from the trend perspective. It's not a very overheated place. And then if you look at a quantile model, which finds the tops and bottoms based on historical data, that all these lines are regression lines from a quantile model, and they will also put us at almost 66th quantile. So if you look at a whole distribution, we are 2/3 of the way up. And this is a log scale, so you don't actually, what's left is quite a lot. But so this is a linear scale, better clarifying where we are. We kind of had a move into the typical FOMO zone, where in prior cycles would kickstart a rapid move up. We got a taste of it, and then macroeconomics pushed us a little bit down. Plus, if you were with us last week with Wizard, he also explained that we had some risks in the market because we detected quite a bit of sell pressure. All right, now moving on to our macro section, I just want to quickly mention that one of the main factors that crashed the market was Jay Powell and the Federal Reserve meeting, FOMC. This FOMC meeting came with an update to the summary of economic projections, SEP. Not every meeting has those, but this time we had them. And these SEP reports give us a really clear view into what the Fed governors are thinking in terms of inflation and economic growth and the rate cut expectations. So what this report was released at 2 p.m. on Wednesday, and that was exactly when markets sold off a lot. If you look at any price chart, you will see that the price was just going sideways, and right at 2 p.m., S&P, NASDAQ, Bitcoin, everything crashes. The thing that happened was that this report was released, and also Jay Powell started talking. But what this report said is the governors expect basically updated the economic growth projections upward. If you look at the first line here, they were expecting a real GDP of 2.0 in September, but the recent number said 2.5. So they now think the economy is going to do much better, which means there would be less need in their mind for rate cuts. But for 2025, they still updated it a little bit. For the long run, pretty much at the same number. And then when you look at their expectation of inflation, core PCE inflation here, for example, they also upgraded that one from 2.6 to 2.8. So this is a really bad thing. The Fed, instead of expecting a reduction of inflation, they are expecting an increase in inflation, which kills the rate cut hopes. And they also project the same increase in inflation next year and then the year after. So it's not really good. And what they expect for fund rate for the rates is basically went up by 0.5 point for 2025 and 2026. Previously, they were expecting 4 cuts next year. Now, what they published here in the dot plots shows that the median governor only expects a 2-step reduction in 2025. So only 2 cuts are projected, at least. And remember, this is all Fed's expectation and doesn't have to be what happens actually. In fact, they mentioned that if data comes in and shows that actually economic growth is very slow, much slower than we thought, then they'll come back with a lot of rate cuts. If the economic growth ends up being faster in the new data points, they will actually stop cutting rates. Same thing with inflation. If inflation data comes in really hot, cuts will be forgotten, and vice versa. So this is Jay Powell also clarified this very well. He said from now on, we're going to see the balance of risks between economic growth and between unemployment and inflation equal, and we're just data dependent. And we don't really expect anything moving forward in terms of, we don't have a bias towards more or less cuts. We'll just see what the data says. So from now on, one data point could really change this whole graph quite a bit. But basically, because the market were expecting a lot of rate cuts next year and those hopes were crushed, we got a massive sell-off in all markets. There were also structural factors in the Bitcoin market that we discussed last week, right? Vizart, can you maybe remind us of the risks that you identified in the market last week?
Yeah, like last week, if researchers and market observers wants to go back and see what kind of tools we could have used to actually speculate about the potential of a correction, or let's see if it's going to be a crash. But the tools we used was, first of all, focusing on who's selling, and we saw starting after 92, actually, when we broke above 92,000 for first time, all the way to 1,000, 100,000. I think 105 was the day we were talking about the price. You could see every rally was actually supported by, happened by the long-term holders selling. And there was a lot of debate on Twitter about, okay, what do you call long-term holder? And most of those long-term holders were the 6 month to 12 month, the people who bought right around before the ETFs being launched or around the ETF being launched, and they were around 50-60% profit. So they were the main sellers, but they were long-term holder. So you could see a huge number in term, both in relative term and absolute term, dollar value. The long-term holder were taking off the table. At the same time, the short-term holder, who are really sensitive to the volatility, were in absolute profit. So this is a recipe for market demand exhaustion. That's when the selling pressure is so high, even though it's being damped by the buy pressure, but there is going to be a time that the selling pressure is going to exhaust the demand side. So long-term holder were actually the main sellers, and we didn't know when the crash or correction is going to happen. I'm not claiming we could see this, otherwise we would be billionaire, but you could see the high risk structure was obvious in the market.
Great.
Yeah.
So, did you sell your mustache to buy more Bitcoin?
Yeah, I should.
Yes. In a very weak moment, I decided to get rid of it, and I was like, "Who's this guy?" A stranger's in my house. Looks like a lot of comments on that. Okay, yeah. I still feel weird. All right, so great. Let's now move on to something I was looking at this morning. Let's see, shift, yeah. The SOPR, and we'll probably have you do a much deeper dive on the on-chain data, but So I was looking at short-term holder behavior, and this is a 12-hour moving average. And basically, we see that they were selling really, really high amounts on Tuesday. Then, and it's actually been going on for quite some time. And once the price began correcting, they stopped selling for a really small period of time. In other words, not stop selling, basically stop realizing profits. And then as price looked to be recovering a little bit, they began selling, realizing profits again. And just today, on a 12-hour basis, we are seeing people selling at a loss. Typically, selling at a loss is correlated with short-term bounces back up. So we'll see how this goes, but it's a good sign that people are tapped out, and selling pressure should subside. But let's move on to your on-chain report, and also hopefully we'll look at funding rate. Well, actually, maybe I think I had another look at, just the other thing I want to mention is the funding rate. It's looking great. If you look at the early part of the December, first of all, this is funding rate, annual percentage rate for BTC, ETH, and everything else. And it's very interesting that before December, market was really hot, and we see today, for example, you see a lot of dark greens, meaning the market has cooled off quite a bit. The funding rate has become negative for several of the altcoins, not for Bitcoin yet, maybe by now, but this morning I was looking at it and it's still positive. But if funding rate also becomes negative, that's another really, really good sign that the market the sell side is exhausted. But for now, it's all moving in the right direction. I guess these were the important things I wanted to cover. Over to you, Z.
Sure. And I have to apologize to audiences because I figured my StreamYard has a limitation on the hours that I can actually broadcast through my social channels. That's why I can't. I have to figure out how can I get the premium account. So bear with me. I'm pretty old.
You don't need to. You're on.
So weird. Yeah, I think I have, based on the description, I have a 10-hour limit per month. And apparently I have to get the premium to be able to do broadcast to my own destinations. So I'll try to figure out, but hopefully people will come back and look at the video after the recorded version. Let's take it from where you left, Sina. Talk about the funding rate, and I'll zoom out a little bit, looking at the last year, like starting December 2023, like from last year. If you look at the market, you could see not only Bitcoin. Bitcoin is
first of all, can you zoom in?
Sure.
I honestly have to.
Sure.
Much better. Okay, so now I can see this is a much zoomed out version, right? It's I was showing
you were showing the last, I think,
last month.
Last month. This one is actually in 1 year, and I'll recommend whoever wants to use this, try to play with the color slider, which is literally playing with the range, and you will see the values that are shown here, by color coded, is normalized to a smaller range. You could see the high temperature or high demand or high funding rate zone better. So that's what I did. These are two settings I used, thanks to CoinGlass, with a beautiful chart. You could see in February 20, I think it was in February, you could see the market when market had its first rally to 70 something thousand across the market, the crypto market. If we want to look at every single funding rate, and this is sorted out by the open interest, you could see there was like an overheated period. What would you mean by overheated period? But you have to understand the perpetual market specifically has a short side and a long side. And short sellers are, if you go look at the researchers and think about it logically, the short side are the low leverage, the people who are shorting the market and they are pocketing the funding rate. I mean, depending how market is paying, the analyzed funding rate is. If it's above the low risk bonds, you could see a lot of investors coming in the market and short. The other side is the highly leveraged people who are trying to speculate the upward moves and they're trying to pocket the actually price going up. Not everyone. I'm not saying retailers don't short the market, but that's the majority. So when the funding rate is high, you are actually in a period that people have the appetite to pay the funding rate and accept the risk on a leverage and long the market. So that's actually a way to look at the retail's footprint. So when you see funding rates going up, that's a good thing. But if that good thing, good phase get extended, that is a bad thing. So at the beginning, when you enter that phase, it's a good thing because you see, we call them degens, but I call them the people who are willing to take the risk and go long, mostly on a leverage. So starting November, early November, where we saw there was a sign that market was actually showing some momentum upward, you could see the funding rate, as we discussed last week, the funding rate in Bitcoin, it was jumping, and this is a moving average, by the way, 7-day. So funding was going up, similar to what we saw in early 2024. It was going up. That's what we were seeing here, but this one is across all the market. But as we went on, and we broke above 100, this period got, I mean, it was not as intense as early 2024, but it was long enough that we could call it actually it's a high risk zone because this high leverage people were in the market. Even though the funding rate didn't go up much, that means the intensity was low, but the time period was long enough that we could say, okay, there's a chance we see a correction. Even though this cycle we don't see that funding rates, but that up and down behavior is very obvious in funding rate, especially in the top formation. If you go back to 2021, when funding rates were, I mean, really crazy, you could see when we were breaking to a new all-time high, we had a couple of ups and downs. So let's see what happens here. But the prolonged period of high funding rate, at the beginning, it's a nice thing. It shows the demand. But when it's prolonged, it is a high risk sign in the market. And that's what we saw. So that is actually from the perpetual side. But we should always remember perpetual market or futures market in general, it is all about the people who are trading risk and their effect and impact on the market. It is what I call short-term to mid-term. But long-term price action actually happens in spot market. And this is something logical. So when we talk about the perpetual and spot, we have to look at both market and see in the correction we are addressing or in the rally that we're addressing, which one is showing more power compared to its own historical values. The best metric that I can use is CVD, even though the CVD needs to be, let me zoom in actually. Is it zoomed in enough, Sina? Do you see the CVD?
I think both of them are looking good.
Yeah. So
The
let
more
me,
the better, but it's good.
yeah. I have to show them side by side, but I can open it. If you look at, because the CVD, it is, we shouldn't look at it as it is. It needs a lot of cleaning. First of all, we have to do a good aggregation. Second of all, we have to make sure the exchanges that have the highest volume, we have to weight their CVD by the volume. Some exchanges have really high wash trading volume. So all the things considered, if you zoom out and look at the weekly moving average, we can get
So
something out of.
tell us
Oh,
what this is measuring.
okay, sorry. CVD is cumulative volume delta. So it is looking at because when you go to the order book, there is a buyer and seller, right? All the time. So for every buy, there is a sell. For every sell, there's a buy. So what is the cumulative delta between buy and sell? we are looking only on the taker side. We are looking at the traders that go in and fill an order, not the one that are putting a limit order on the order book. So we only look at the takers, the ones that are go and take a deal and fill a buy or sell order on the order book, and look at the buy volume and their sell volume. So usually they sell volume by takers, because takers are the one that are willing to pay the spread to speculate on the next move. Either is a 1 second or is it 1 year. They are the one that are paying the spread on either side. So when the takers buy side is strong, you could say the speculators are strongly bidding on the upward, because market maker has to provide liquidity on both sides, but it is the takers who are aggressively bidding on one side. So when you see CVD going positively up, this should be both should be in the same color, but this is 0, by the way. So when we are above 0, that means in a strong buy by taker side. And this is for the spot market, the same metric, but it's shown in the negative and positive um, values are shown by green and red. So when you see a strong buy on both market, you could see, okay, both of them were having the same sentiment. So the recent sell-off after
So let me
breaking, yeah,
take a look a second. So this is everyone who this is measuring who basically did a market buy and they didn't have a
market
limit
sell,
order.
both.
Market buy or market sell. And then what
And
you
this is the
capture.
net value. Yeah, this is the difference between them.
Yeah.
So let's say I go like it's me and you, just two takers in the whole market. I go sell 100 million Bitcoin in the sell side, and you go buy 200 million. The net value is 100 million. That's how it's calculated. Positive 100 million, because you did buy 200. I sold 100. So the positive cumulative CVD is going to be 100 million now.
Okay. But you're excluding everyone who had a limit order because they are less aggressive people, right? So we exclude those and we just look at market buyers or market
Takers.
sellers to
Yeah.
see what side has more aggressiveness. So when it goes above 0, that means more people are speculating on, more people are aggressive in the positive side and the other way, right?
Yep. That's so a combination of CVD and funding rate would be a great analysis of the perpetual market. Here, the reason I'm putting these two next to each other, because there are lots of details. You cannot simply open the CVD and define the sentiment, because sometimes you could see a sell-off in the spot market, but that is actually in a combination with another big strategy going up, like probably longing in the futures market, and they're covering their long. That's why they're selling here. It could be a combination, but when you see a prolonged confluence between both market, perpetual or futures, and a spot market, there is a high chance that you call this is a negative, especially when there you have a big sell-off. So you could see after breaking above 74, and then we went all the way to 89. 1, 2, 3, almost 3 wave of strong, because look at the historical low values. It's around 25 million, 25 million. Then in very rare occasions, we had plus 50 million sell-off, net sell-off in the futures market. You could see actually in when we broke above 95, we had the largest, it's around 54 million negative CVT. That means on net, 54 million sellers were in the futures market. The same kind of waves we could find in spot market. So my point is, especially after we broke above 90,000 on the order book, I'm not talking about on chain yet, you could see there was a strong aggressive sell side on both markets. And that was happening every single time market had a rally. You could see the sell-off started. So we had 1, 2, 3, and starting when we hit 108,000, 108, we had another sell-off in both. Like, let me zoom in. You could see we had a strong sell-off up to 24 million in futures market, and in the spot market it was around 10 million. The numbers are different because the volume in the future market is higher. It's highly higher. The liquidity is much higher than the spot, and bunch of it is leverage anyway. But like I said, you have to compare each market by its own historical value. So you could see in both markets there was a sell-off, and then we can go back and look at the on-chain data as well. So if I wanted to just focus on the perpetual and spot market, that's the metric I would have used and say, okay, look at last 3 weeks, 4 weeks. Every single time we have a rally, we have a huge sell-off in spot, and especially in the spot is really important, because look, the rally we had above 100,000, there was a strong buy, but then the sentiment changed to strongly negative. But like I said, you have to do a study and do not take these charts as a grant. I mean, just don't take it as a face value. You have to do a study and especially look at on-chain data, because sometimes this is a part of another strategy. But recent weeks, you could see all of them are sell-off. So yeah, that was the case. And I want to actually use the last week's framework again, just a little bit change it. Because last week we talked about, okay, the funding rate is dropping. We had one of the hugest liquidation at December 6th. We had the reduction in open interest, like we discussed. That means there was a lot of liquidation. But the yesterday, I think it started yesterday, rally, I mean, not rally, it crashed to 90,000, almost 91 or 92,000. The drop in the funding, in the open interest on perpetual market is getting smaller and smaller. That means the
So for everyone who
aggressive,
doesn't
yeah,
remember, these are just drops in the open interest and futures market. So basically, how
yeah,
many positions were closed that we
yes,
were looking at last week? Yeah.
yeah. So this is the open interest on the futures market. You could see since we broke above 100,000, every time they try to, I mean, speculate on the market going up, we had a reduction in the open interest. These are the people who are either liquidated or forced to close their position. You could see this is getting smaller, smaller, smaller. That means that aggressive part of the futures market, the ones that are trying to speculate on leverage or aggressively long the market, they're getting, their footprint is getting smaller and smaller and smaller. That's what I said is scary when the high funding rate period. That's the scary part, because the people who are willing to long the market and pay the premium are getting flushed out, and you could see that flushing out happen every single time we had a rally above 100. And now the drop in the funding in the open interest, which is this one, is getting smaller and smaller. So the demand on the futures market, especially the leverage ones that are trying to long the market, they're spooked, they're scared. And you could see their demand or appetite for longing the market is diminishing. If we don't get an upward market move, that is a scary thing for midterm to long term. Then, if you look at the liquidations, you could see, yes, in terms of volume, we had much bigger liquidation for early stages of breaking above 100. But as we go on, the liquidation, these are long liquidation. Now we are seeing, okay, when we broke below the 97,000, you could see again on an hourly basis, we are seeing the same intensity of liquidation. That is telling us the flushing of the high leverage long positions in the market is happening. It is a good thing when we have I mean, if we have another move up, but if this flushing keep continuing, keep scare and make the appetite for long in the market diminish in the market, that is a bad thing. So let's see what happens. But if we want to just rely on the spot market and perpetual market, this would be a perfect I mean, moment in the market that we could see a reversal. But all this depends on the demand side. So we could see the demand or the scared people start to sell their coins. If we wanted to have a bounce back, this is the point that I would expect a bounce back. But no one can say what happens tomorrow. But if this phase keep continue and get prolonged, I would be scared. I would speculate on a midterm to long term bear market.
So
Here
wait
we
a
can,
second.
yeah.
What makes you look at this liquidations and think there is a possibility of a bounce back? So is that a threshold you're looking at, or is it because we've had several spikes? How do you decide on that?
So first of all, you see the liquidation is, I mean, the level of liquidation start to, I mean, the maximum, these peaks. You could see it is actually degrading over time. Is getting lower and lower and lower. That means the high leverage position are flushed out, and usually in that that's the structure that the spot market have the drive to go up. That is the recipe. But the other thing I look at when I see these peaks are low, I mean, diminishing, is the funding rate, because funding rate is looking at the intensity of that aggressiveness. Liquidation shows the effect of price on the open interest, but funding rate shows the appetite. That's what I'm trying to just clarify here. When we see those people who were long in the market, now they're liquidated. If the funding rate stay above the neutral value, which we discussed in previous episodes, especially on the 7-day moving average, that means, okay, they got flushed out, but they still are in the market, and the funding rate has not reached below 0.1%, which is the neutral value. That means the demand is there, it's just more cautious. But like I said, if we see these people get liquidated, if we see the funding rate go below 0.1%, and also we see the CVD, which I showed just before this chart, still is negative, these are all perfect recipes for midterm to long-term bear market. I'm not saying all the time these indicators are going to work, but if you look at the historical pivot points, always before a bear market, all these three that I just described happen. The liquidations on the long side start to diminish because less people are long in the market. The funding rate drops below the neutral value, which is 0.1%. 0.01%. That means the appetite is not there. The third thing I'm seeing is the open interest, and the one that are trying to long the market, openness in general. The demand for speculating on the market is starting to get smaller and smaller as well. These are the three things we're saying. I'm not saying we are actually seeing all of them at the same time. The only thing that scares me is just the funding rate going and getting. Let me see, what is the 7-day moving average now? I think it's the mean value is 0.08. So on the 7-day moving average is below 1. If this continue, I would be spooked. I say, okay, looks like at least in perpetual market there is not much demand, like what we saw in early 2023. You could see it's above 0.1%, and then we rallied up. In early 2020, you could see the funding rate broke the moving average above 0.01. Then we had the rally. And the other side, when we broke for a meaningful amount of time or days, broke below the neutral value, we had a bear market, and it stayed there all the way until we have another rally. So this is a good indication for the aggressiveness of those people who are trying to long the market. And as you can see, we had a good run starting from 90,000 all the way to 108. Now we're seeing that funding rate dropping. If we keep continue like this all the way to Christmas, or I don't know, next week, I would be scared at least for a midterm. By midterm, I'm talking about month, or I don't know, like how long the bear market is going to be. Let's look at the on-chain, because all this thing that we discussed so far, Sina, is just order book. It's where the price action happening. But on-chain is more about behavior, and is a longer term, dimension of the market. I mean, the change in the on-chain data usually takes time to manifest itself in the market. So I like it not for prediction. It's just a zoom out and give me the macro view over the market. Do you have any particular questions so far, Sina?
Can you hear me?
Yeah, I can hear you.
Okay. Yeah. No. Very good. Very good. So, looking forward to the on-chain part.
Yeah. So, I'm going to share this dashboard for people who have access to on-chain data, but I'm pretty sure people who are keen to find these metrics, there are lots of free on-chain data providers out there. But if someone wants it as a clean dashboard, Sina will kindly put it in the YouTube or Twitter channel, and you will have access to this dashboard. So don't worry if you want to have, I don't know, the live version of this chart. Glassnode have this dashboard available for you. Or if you want to find it somewhere else, feel free to just search the title. Hopefully you find something on a daily, at least on a daily resolution. But as we discussed last week,
I just thought of a question though.
Yeah.
So this is an interesting idea. I typically look at funding rate dropping as a really positive thing. And we love to see actual negatives. But what you're saying is negative is good only if it's short. So it actually can, if it's below 0.01, for a persistent amount of time, for a long amount of time, then that's actually negative. So that makes the analysis very difficult, right? Because the
Yeah.
same low number could be positive at first and then could be negative later. How do you reconcile these two?
So the way I try, at least for myself, I try to have a framework in my brain. Like you said, it's negative. It could sometimes it's positive. How can we differentiate? First of all, look at the extremes. What do I mean? The way that perpetual market or derivatives are affecting the market. Let's say the funding rates. Take the funding rate definition, which is the premium between the ticker in the. If I want to simplify it, oversimplify it, is the difference between the price that you see in the perpetual market and the spot market, right? That is the main component of the formula that they use to calculate the funding rate. It is that. But I mean, it is a little bit more complex. But let's say that's the definition. So when there is a high funding rate, that means there is a high demand in the perpetual, and they're aggressive on the long side, and there is a chance to arbitrage between the spot and futures. That's why you see the price goes up. That is how the perpetual can affect on the market and the spot market, because they have to buy in the spot and sell on perpetual if they want to do arbitrage. And there are some buyers in the perpetual who are willing to pay the spread and the premium to long the market, right? So when that appetite dies, that is the negative side of it is, okay, the demand to long the market, the demand that could incentivize the arbitrager to buy in the spot is dying. But it could be positive if that demand in the spot market is really strong. So that temporary pause in the perpetual market is flushing out the high leverage investors in the perpetual, and clear the way for the spot market to keep buying and price go up. So the weight that perpetual can have on the spot market, in some cases when the perpetual go to negative or get smaller, it is lowering the negative effect of the perpetual market on the spot market. If there is an arbitrage happening, if there is lots of capital being discharged from the market through the funding rate, all of them get smaller and smaller. The incentive, they have, like the cash and carry. Remember the cash and carry we discussed? They were
Mhm.
selling, they were selling in the perpetual market, and they were buying in the spot. That was what they do. They're shorting the market just to pocket the funding rate. So when the funding rate is getting smaller and smaller, they start to close their position. That is actually a good thing, because more people can go start to do aggressively buy and pump the market again. That's why I'm saying if it's a short amount of time and you could see the demand momentum in the spot market and on chain still is strong, in those moments, perpetual market cooling down is a good thing, because the incentive for shorting the market, and I mean being high leverage and having a negative effect on the spot market, is diminishing. But if we keep continue and we have a long period of negative funding rate, that shows the demand in general is dead. Like the demand momentum is not there. That's the threshold I have. So I look at the funding rate, and then I look at the spot market and on-chain. If the momentum in the demand side is still strong, I would not be scared of the small period of negative funding rate. But if I see the negative funding rate, especially on the weekly or bi-weekly moving averages, that means the demand side is dying in the perpetual, and probably that's going to happen in the spot market as well. That's the threshold value. If the demand side isn't really weak, I would be scared of those negative period of funding rate.
What's your favorite way of gauging demand being weak?
Okay, that's a really good question. Three things I would use to say, I mean, from on-chain and spot market. First of all, is that CVD. Is if you see a strong CVD in the spot market, like these periods, see, it's
Uh-huh.
very strong. This is a good, I mean, easy to find indicator that can tell you, okay, because it's barely becoming positive. I can explain in future episode why it's usually negative, but when you see this very strong compared to historical value, 5 million positive is really significant. Look, we had 15. When we were broken 90,000, we have 15 million. So that's the first easy indicator I would go. So the spot CVD is one of them. The other thing is, let me open the actually on-chain data. The easiest one is this one. We call them, I think we have it for Ethereum, Bitcoin, everything. Realized cap by age. So realized cap, everyone knows what it is. And I'll repeat myself, is the amount of wealth that are locked in the market. And thanks to Glassnode and all other on-chain data provider, we have the ability to break down this locked in wealth in the network by their age. So if you turn off, I mean, just look at the 1 hour to 1 week, okay? If you see just the investor that are entering the market in last week, when you see there is a strong, and this is a no moving average, a strong portion of the realized cap in hands of people who are entered in last 7 days, that is a sign of high demand in the market. That is a good thing. When you see it's rising, let me do like a moving average, for example. If you see it's rising, that means the amount of wealth from total wealth in the Bitcoin network or any other network are in that wealth is in hand of the people who are entering the market. That is a strong demand. They're coming and buying, and they are hodling, and the people who are hodling between 0 to 7 days. These are, we call them hot supply. This is the demand side of the market. When there are lots of, I mean, demand in the market to buy the coins at premium, entering capital into the market, you could see this metric goes up. And as you could see, we had a upward trend all the way from 2023. Then we had the peak. That means a lot of these people entered in the last couple of days when we were moving to 74,000. If it's a peak in it, that becomes actually, again, a risky situation in the market. But if you see the baseline going up, that is a positive thing. So we have to see, like I said, on-chain is a little bit for longer term. If the baseline or longer moving average of this is still going up, that is a good thing. But if like early stages of 2023, like 2020, it was dropping and dropping, it was not bouncing back. It was a sign of, okay, demand going out of the market. Or after 2021 top, you could see the baseline is dropping. That means those appetite that I talked about in perpetual market, it is this is the same kind of thing, but in a macro, from a macro perspective, you could see the wealth in the hand of the short-term, ultra short-term holder or new investors is getting smaller and smaller and smaller. That means there's no new buyers, there's no new demand. That is what I would use from on-chain. In addition to that, the spot CVD, and also looking at the funding rate, all of them together, I could say, okay, from a longer point of view, on a longer time point of view, there is a demand or no, there is no demand. So far, we could see that the spike, that high risk spike that I talked about, a lot of new buyers enter the market after 100,000. These are the 1 hour to 7 day investors, and they had almost up to $72 billion net wealth in their hand, and that was a sign of risk anyway. Now we have to see when this is cooling down. Do we keep that upward trend, I mean the baseline, or no, we are entering in a diminishing baseline? That is a bad sign, and that is a sign for bear market. I don't know how long it's going to be, but even after 74, you could see the baseline was there. We were not seeing it, even though market was crashing to 50 something. The baseline was there. We were not seeing a long-term decrease in this hot supply realized cap. I just want to, because I think if you search realized cap by age, you can find this metric everywhere by the same name, but the meaning of realized cap is literally the wealth. It's not it's similar to market cap, but it is, like I explained before, it is the net value of the money that was injected, capital that was injected into the market. And now we just filtered it by the very, very new investors. That is how I actually probe into the demand side. And I think it's pretty complete picture if you put this one next to CVD from
and it's a very complex metric, because you want the masses to arrive, and that's actually what drives the price up. You want more buyers to arrive, but But when there are too many hot coins, and your taxi driver is shilling you some altcoin or whatever,
Yep.
that's when masses have overextended themselves. So that's why, the same metric could be good at first and then bad at really high levels.
You put it very nice. Look at, I mean, it's a Bitcoin show, but look at the Solana. I mean, one of the very hyped shitcoins in this cycle. Look at how much demand was pumped into the market through Solana, and you could see, I mean, if the market start to go down, go south for the Solana, it is a big portion of their realized cap in hand of the. You could see, like, from the bear market, look at the money they got locked in, and look at Ethereum. I mean, these two were fighting each other. See, the demand, the baseline demand in the Ethereum was actually not seeing any jump compared to the bear market. But Solana, look at it. Even Bitcoin showed a strong move from the bear market. And this is a very good indicator if you want to compare the demand in different networks. And Bitcoin had a robust build up. Yeah, you won't see that jump in the like we saw in Solana, because we're talking about 24 billion, and that's the baseline. So Bitcoin is a bigger market anyway, and it's harder to, I don't know, make any move in these indicators. But comparatively, Solana and Bitcoin saw the demand this cycle, but Ethereum, no, it didn't, compared to their baseline in the bear market. The recent couple of weeks, there was some news about, okay, Trump is going to be pro crypto, and you could see their ETFs had some inflow. Yes, you could see there was a jump in demand, but in general, since early 2023, they have just a couple of these peaks, but the baseline is pretty plateau, flat. So that is a good indicator for demand. But like I said, you have to put them next to other metrics like funding rate and spot CVD. So
Can we go back
far,
to the
yeah,
Bitcoin's chart?
sure,
The last one, yeah. Just Bitcoin, yeah.
Bitcoin, yeah.
So would you say the fact that the hot supply is so high at the end in the recent weeks, would you say it's a risk?
100%. Like, if you
Yeah,
put a
because
standard deviation on this, that's a very good indicator of risk. When you see you are 5 times, 6 times above the baseline, well, that means your taxi driver, like I said, and your friend that you never talked to in the last 3 years, this is actually them. They are entering the market because this is an unnatural increase in the hot supply. So that is something that we call risk in any, I mean, by any definition. If you have out of range move in any metric, you could have some risk, and this is a risk, actually. Yeah.
okay, so we'd probably have to wait for some time so that the 1 week coins become 2 week and then become 1 month and they just age more and more.
Yeah.
So we get more confidence in these new purchases not becoming sells.
Yeah. And like I said, we have to look at the baseline, putting a moving average on this and see if the baseline is dropping on top of the lack of appetite in the perpetual market. All of them together becomes super negative. But if the momentum is still there, those short period of the negative funding rate is a good thing because they are flushed out. Spot market becomes strong again, and we might have a move up. So you have to follow this metric on an hourly basis if you want to be a trader or a speculator. But if you want to just sit back and look at what's happening, I really like to look at it on a weekly basis with you, Sina. I mean, yeah, it's fun. So far we established, okay, we had a high risk following to what we discussed. So people would ask who were selling. On the previous episode, we talked about long-term holder. So we were here, you could see long-term holder were realizing profit like crazy. On an hourly basis, they were realizing up to 300 or 400 million per hour. So look at the baseline. This is last 1 year. The baseline is around, like, when you look at this, 8 million, 10 million, and I mean the spikes is up to around like 70 million. So this is the range. But when you have a crazy period, I think starting November 9th, these peaks were in range of 250 million to 400 million. And the blue color is long-term holder. So you could see the majority of profit taken off the table was by long-term holder. And if I, instead of 1 year, look at the 5 years, I want to show you the pattern. I mean, see, in the bull markets, when the market break above the previous all-time high or go way above previous all-time high, the long-term holder becomes sellers. Aside, I mean, next to the short-term holder, but the long-term holder is more significant because for the majority of the bear market, they are not really taking any profit. See, so you could see this wave of profit taking by long-term holder was significant. But look at the values here. I mean, double what we were seeing in 2020 because the market got bigger, obviously, but the period was long as well, like all the way from 90, I think 78,000. Then when we broke above 90,000, it's a one wave, second wave, third wave, 4, 5, and even now we're seeing they're realizing profit, not as much as what they were doing above 100, but you could see still they are realizing profit. And these waves was pretty alarming, and we have to see when this cools down, does market see another wave of demand through that realized cap, that realized cap by, I mean, hot supply again or not. But yeah, that was a big sell-off. So long-term holder was starting to form the top, what we call top formation, when they start to sell, take a lot of profit and exhausting the demand. If you look at the number of coins they were selling, because this one is the pace, the intensity, how fast they are realizing profit. But if you want to compare the amount of coins they just deployed to the market, let's zoom in the last 5 years. So at their peak, I think it was, let me zoom in better, it's around 650,000. So this metric is showing, let me open it, it's better to show here. At their peaks, long-term holders were selling, or you could see their supply was reducing at 650,000 coin per month. That is the rate of selling their coins. You could see we had a strong buy during the market going sideways. That is another metric that I would look at. If the long-term holder are adding to their bag, that's another sign of demand. But these are patient buyers. They're not like so you could see a couple of years of long-term holder adding to their bag, and then we see a bull market. But you could see they had a little buy when we broke below 70,000 and we have 50,000. Then starting break above 68,000, you could see they were selling. And compared to the historical values, it was a pretty large amount. Look, it's way more than the previous top, and the maximum record we had, it was 2020. If you want to compare the values, it was around 800, 950,000 coins, and then market rallied a little bit after. I hope that's the case as well. We had a little bit sell off because last week I said I hope, I don't know, but I hope we have a correction. So I think if you want to have a rally, it's better have it soon because it would be very similar to what we had in 2020. But if we don't see any demand coming back, this could, like the sell-off we had here, and we see no funding rate, increase on a 7-day moving average. If you don't see the realized cap by the hot supply increasing, that is a bad sign for midterm. There are lots of counter arguments here. They say, okay, 2016 we had a lot of sell-off, and the market kept going up. That means the demand was sustainable. All those charts.
Yeah, I think what happens is long-term holders are smaller than short-term holders. So this is only showing half or less than half the picture, right? So
yes,
it also matters what everyone else is doing.
Yeah. So when you see such a thing like a big sell-off by long-term holder, the least you can tell is, okay, I expect a little bit weakness in the market, but no one can predict the demand side. Like 2016, it has 1, 2, 3, 4, 5, 6 wave of sell-off by long-term holder. Still market went up because the demand was sustainable and there was some incentive for the other side of the table to enter the market. But usually when we have a strong peak, expecting at least a midterm correction or midterm weakness is not, a crazy speculation. So yes, it is something normal, but we're not saying, okay, it's like 2020 done, we're going to go to bear market. It's just a good chance that we see a midterm to long-term bear market. Let's hope it's a midterm or maybe short-term. All we can say, okay, this was another piece of puzzle that could have tell us there's a weakness in the market. But tomorrow, maybe there's lots of news on the treasury. I'm not speculating about is it really positive for Bitcoin or not, but at least at the beginning, it could be a positive thing. Maybe they talk about it in January and the market go up. these are all like speculation. But what we could say is what happened. What happened in the last couple of days? One of the big factor was long-term holders selling. The other thing is short-term holder. Now, if long-term holder are selling, as soon as the price go below, they're getting close to their cost basis, they start to lower their selling pressure, like you see, like in bear market. But the depth of bear market is usually in hand of the short-term holder who are selling in loss. Because, like I said, these are taking profit, and then their incentive to sell is the price. If the price go below get closer to cost basis, they won't sell anymore. These are by definition, they are sensitive to profitability, and they wait for the market to give them the chance. But short-term holders are the one that are sensitive in both ways. That means if the price get closer to the cost basis or break below their cost basis, they start to realize loss aggressively. So that's why the short-term holder are important when we enter to a pretty bearish phase. Let's see, like you showed, the SOPR was going to negative value. I'm below 1 actually. Now we can expect, okay, let's imagine the demand is sustainable, where we would see this short-term holder that bought, like the taxi driver talked about, that pick in the realized cap, the one that are bought, when they get exhausted. So that could be the case if the demand is sustainable. We want to see these sellers that are selling in loss get flushed out, so there is no sell pressure. That is a perfect situation or textbook definition of the rally going keep continue. So let's look at the short-term holder and see where they might stop selling if the price goes that much down. The first and easiest metric that I suggest everyone to speculate about the people who are realizing loss, because I repeat myself, long-term holder were realizing profit, the price go down, they stop selling because they are incentivized by profit. But short-term holder, if the price go down too much or stays down too long, they start to realize loss. And that is the recipe for a bear market. Let's see what they're doing. First of all, their MVRV, or the ratio between the price and their cost basis, is still above 1. So usually in the bull market, their cost basis is below the price for most of the bull market. So by average, most of the short-term holder remain in profit. But something weird that happened in this cycle is every time we had a crash or we had a sideways market, the MVRV of the short-term holder had a bounce back around 0.9 or 10. So by average, when they got 10% in loss, they start selling. I mean, market start to go up. I mean, that was the end of the sell-off by the short-term holder, you could see. Right now, the MVRV is 1.12. So what is the cost basis? So what I'm trying to say is when price breaks below or get close to the cost basis, if it get a good support, if it goes sideways around their cost basis, there's still a chance that market sees, okay, the people who are scared are flushed out. The long-term holder were taking profit, they're flushed out. So the sell side is cooled down. Now let's speculate about their cost basis. The cost basis of short-term holder is this blue line. Let me zoom out. And last week, remember, I was talking about we are hitting one standard deviation above their cost basis, and usually it's where we call it's high risk zone, and we getting really close to their cost basis. I mean, the red line is one standard deviation. The cost basis of the short-term holders is around 85,000. What it's telling us is as we get closer to 85,000, if the short-term holder that are selling and taking some profit, and they're selling on a little bit loss, when we get close to the cost basis, there is a high chance that they stop selling aggressively because there's no incentive for the one that are trying to take some profit. And we need support there. Like, look what happened in early 2024.
So let me rephrase this for someone who's seeing this for the first time. Basically, that black curve shows the MVRV of short-term holders, which is a measure of unrealized profit.
Yeah.
If you have so much unrealized profit, and if you're a short-term holder, by definition here, you're looking for short-term trades. And if you are in profit by a lot, this might incentivize you to sell. But when you sell and you've realized all the unrealized profit, MVRV goes back down to the neutral level. And so there's no more profits to be had. Now, if people are still positive about the continuation of the market, they will stay put. They'll just not sell or not buy. And especially if price goes even further down, they won't try to sell at a loss. So a negative value will below one value will slow down the sell pressure quite a bit. People don't want to lose, don't want to sell at a loss unless they completely capitulate.
Yeah.
Yeah.
Yeah. So let's hope. I mean, if the market, this metric is telling us if the market and the price in the spot market stays above 85 again, and funding rate doesn't break below neutral value for a long time, and we see the baseline in the realized cap or hot supply still is upward or sideways, these are all a recipe of bull market continuing. But if the price get closer to the neutral value and break below, like what we saw here, or like we saw in early stages of bear market in 2021, if this happens, that is a sign of the bear market, especially if we don't see the baseline in the realized cap that we discussed doesn't go up. So you have to look at all of them in together. At the moment, if the price stays above 85 and the funding rate get close to the neutral value and stays there, do not break to the negative values or way lower than neutral value, and we see the CVDs on the spot market and perpetual market turn back to neutral or a little bit positive, these are this situation I would call a small pause on the bull market. But the other side of the coin is all of them go negative. This price gets below 85. That is a recipe for midterm to long-term bear market, where any external factor like Luna crash or FTX crash can deepen the market. But I suspect the ETFs, the good thing about ETF is probably because they are different buyers and their incentive actually sometimes may push them to buy at prices that are on discount based on the value they're considered for Bitcoin. Maybe, I'm not sure, in the coming bear market, if we have any in coming month, the ETFs are gonna cause the market show less volatility to downside. That is what I expect. I'm not sure what's happening, but the eyes are on 85. Not because I'm a technical analyst. I'm just looking at the cost basis of people who are really sensitive to price volatility. 85 is what I will look at. On top of that, there is a really beautiful chart that Glassnode recently put out. This is something similar to the heat map that we saw in CoinGlass. I'm sure a lot of people is one of the most favorite. This one, you saw this on Twitter a lot, right?
Yeah.
They put the liquidation. This one can change really easy because these are the position that could be part of the another scenario. They probably could be spooking the order book, and none of them. I mean, not all of them are going to be liquidated. Some of them might close before price get close to them. But this one is on-chain version of it. This one is telling us the amount of coins that have been bought at that price, for example, like 66, and how many of them are holding and not moving their coins. As you can see, around 62 to 67, there is a big chunk of supply that changed hand. That means new buyers jumped in and bought them, and they're still holding. Do you see, Sina? That could act as a really good support, like what we saw when market after FTX broke below 70,000. Look, it got red. That means a lot of buyer bought there, and the market started to rally up. When we were, I mean, before the ETFs being launched, I think it was mid 2023, you could see a strong buy were entering the market and buying, and you could see it was heated up. So let's zoom in the last couple of months, actually, instead of 3 years. I want to support that 80.
But these are today's cost basis, right? So
yes,
if somebody sold, it would be removed from the lighter colors.
Exactly. So look at, for example, 62,000. It was pretty red. It means above 400,000 coins was moved at it. It is diminishing, so they're selling, but it still is very significant. I mean, when you put the color code, is 300. But look at that's what I would talk about. 96,000. There was a really nice cluster. I mean, forming between 87 all the way to 97. We have to wait. We have to see if the price breaks below this. Do they sell? Do we see these orange, beautiful lines become disgusting blue? losers that are selling. We have to see. But I really like this confluence between this cluster of buyers, because you could see all the way from 87 to 72 or maybe 71. You could see we don't see any support. So there is, if we break below 87, that's when I would be scared. 85, I would be scared. But in continuation of my theory about 87, you could see 85, the cost base of short-term holder. You could see a good cluster is forming above 87. That means buyers are buying here, and hopefully this becomes a support level in mid-term and long-term. But we don't know. Like if we break below the 87, yeah, we could see price go all the way down to around 67. But I like this cluster being formed here, and it's really similar to what happened after 74.
But
Yeah.
if you go back to the chart, yeah, just this is good too. Like the actually the largest concentration is at right below 100, right? The red part.
Yeah,
It's right
97.
where we are, like at 96, where we are right now. What does that tell us?
That tells us there is a big chunk of buyers that still are at profit or at cost basis, so they won't sell. But we don't know, are they going to be like short-term holder? If the price break below, are they going to be like look at here, look at the one that bought here. They were holding for a couple of months after. Look at here, they were price broke below their cost basis, but they kept holding. See, even though price dropped below their cost basis, they were holding. It's still red. So we have to see if this red color and red, I don't know, bar we call it, or red level stays red. That means they're hodling, even though price is breaking below their cost basis or is around their cost basis. So it's all matter of their incentive. That's what would matter. But so far, you could see the price got to that 97. That means there is a buyer. I'm not saying it's ETF. I don't want to speculate, but it is a significant buyer or buyers at that level. Let's see what happens, because market is evolving every single hour. Maybe they got the bad news and they start to sell. But so far, that 97, all the way from 87 to 97, that cluster of buyer are very similar to what we saw. Let me make it 1 year instead of 6 months. Very similar to these buyers. Like, look, market broke here. I mean, start to have this. Oh, sorry. We had this cluster buying here or here. They are speculating. They're buying. They're not saying market is going to go up. But the recipe, I mean, the good sign that we are seeing a cluster happening here and buyers are buying and hodling, see, is extending. This yellow orange is getting longer and longer. That's a good sign. But we have to see. Let's see if market actually, I mean, stay above their cost basis. This is like I said, in all our episodes, I like to do bear and bull. So far, I talk about bears. The chance is a bear market. Funding rate is not reviving. Hopefully, it will rise. The spot and perpetual has a negative CVD. But on the other side, you could see 87 or 85 to 87. This is a good, there is a good chance that we see these sellers stop selling when we get close to 85 to 87. If we get, I'm not sure. So let's hope 87, 85 is the Santa's gift for us, for the people who want to buy, and is a Santa gift for who are scared and they want to sell, and 85 is their last resort, and I mean, they're gonna say, okay, staying above 87, I'm gonna be a hodler. Hopefully the 2025 is gonna be a bull market. So that's the level between super scared or just be cool with the price action type of threshold for this episode. 85 to 87, and like I said, it's not a technical analysis result. It's just on chain, and we have to see if it actually hold up.
Yeah. So especially, because the recent crash was at least precipitated by a macroeconomic surprise, I wonder if how long this might go, because it was a really big surprise and all the other markets also sold off. I'm wondering if people are kind of overreacting, and this is probably the peak bearish the Fed could have gotten, pretty much delivering significantly below what the market was expecting. So there is also a possibility that we get different economic data, and stock markets begin to rise again and bring back demand. So this, honestly, to me, it seems like this was all from a TradFi push into Bitcoin rather than internal dynamics. So we'll see what happens in the next few weeks.
Yeah, let's see what happens. But I mean, Merry Christmas. I think we won't have another episode before Christmas. So Merry Christmas to everyone. To you, Sina. I really like this show we have. It incentivized me to go beyond what I'm doing on Glassnode. Because on Glassnode we have routine reports and we try to deliver value and insight to clients. But this episode that we have together at 21st Capital, it gives me the chance to be, I don't know, go crazy and have time to look into questions for myself and then try to answer for everyone else. I really like this session, especially the opening you have on macro. When there's a confluence, like you said, there it looks. I agree. I mean, personally, between me and you and our audiences, I believe this one was, yes, long-term holder were realizing profit, but that extra push from the external factors, which was Fed or fund, whatever is going to be the interest rate, that was the extra push. So let's see what happens. I really like our session together.
Yeah, thanks a lot for joining. I mean, we are lucky to have you bring in a lot of analysis that you spend quite a bit of time on to our show, and thanks a lot. This is a wealth of knowledge.
My pleasure. My pleasure.
And happy holidays and Merry Christmas, everyone. Talk to you next week. We'll see. Next week is actually in the middle of some holidays, but if nothing weird happens, we'll probably do this. Otherwise, the next session will fall in the new year. Either way, thanks for staying with us, and we'll see you soon.
See you.